China is one of the largest markets in the world and has been instrumental in driving global growth since their economic expansion began over 2 decades ago. In fact, according to Global PEO Services, China is now the second largest economy in the world when measured by nominal GDP and may soon surpass the United States to become the largest. However, recent data from China has led many economists like Michael Pettis, a professor of finance at Peking University's Guanghua School of Management, to speculate that a Chinese economic crash could be imminent. He stated that due to the domestic financial conditions in the country, China is still unlikely to have a sharp economic contraction or a financial crisis. He then says that, in his opinion, it is very much more likely that the country will face a Japan-style period of low growth for a very long time. Indeed, if these bearish trends continue, it's possible that we could see a major downturn in China's economy sooner than later. China has been one of the biggest sources of new manufacturing jobs in recent years. Many experts believe that these trends are about to end. Welcome to Savvy Economists. In this video, we will explain what has led to this situation and how the crash will lead to a terrible global recession. Please watch, like and share this video. Let's dive in. Chinese banks have been lowering their standards to help fund the government's spending programs and its ambitious infrastructure projects. According to Guli and colleagues' research published in 2021, about 18 bubbles had been created in major sectors of China in previous years. This includes everything from the mainboard market to the growth enterprise market, GEM. The risk of such a large bubble bursting is increasing. Worries are rising over the health of the banks as well. These loans are not necessarily sustainable in the long term. While they can run to some degree, they will not be able to do so indefinitely. And when they stop lending, many companies that are already heavily indebted will collapse. This could lead to a recession, with GDP growth slowing to single digits or less. Why China's economy is in trouble? As with any economic downturn, the state of the global economy is the first thing to look at. In this case, we can note that although the global economy is growing, it is doing so far more slowly than it was at the start of the year. China's economy is in trouble. The country's growth has slowed sharply, and its stock market has been in free fall. There are several factors behind China's economic crisis, including the country's massive debt load, the declining competitiveness of its exports, and slowing growth in domestic consumption. These factors have all been exacerbated by the trade war that China is currently engaged in with the United States. This trade war all began in 2018, and it was orchestrated by former U.S. President Donald Trump, imposing tariffs/quotas on imports and then calling foreign imports a national security threat. The tariffs that both countries have imposed are taking a toll on Chinese exports, and the uncertainty created by the trade war is causing businesses to hold back on investing in China. At the same time, the global economy is also facing a slowdown in growth in major emerging markets, particularly Brazil, Russia, and Turkey. This downturn is related to the growing strength of the US dollar, which has made it more difficult for these countries to pay back their dollar-denominated debt. The Chinese economy is in a very precarious position, and it is unlikely that it will be able to continue growing at the same pace that it has in the past. This could have severe implications for the global economy, as a recession in China would likely lead to a recession in other countries as well. How the bad economy in China will affect global markets. When the second largest economy in the world sneezes, the rest of the world catches a cold. That's why economists are so worried about China's recent economic slowdown. China's economy has been cooling off for a while now. Growth in 2018 was the slowest it's been in 28 years. And things have gotten even worse this year, with trade tensions between China and the US still looming and adding to the country's woes. For one thing, China's government-controlled economy has struggled with rising debt levels and inefficient industrial policies for quite some time. This has led American economists and chess master Kenneth Rogoff to say in 2018 that a Chinese economic crash is inevitable and will surely affect everyone. Now, there's growing concern that China's economic problems could trigger a global recession. Here's how that could happen. 1. Slowing growth in China would lead to fewer exports for other countries. If China's economy slows down, demand for its exports will also decline. That's bad news for countries that count on China as a major market for their own goods and services. 2. A recession in China would lead to job losses and lower incomes worldwide. This is because China is a significant player in the global economy, and a recession there would have ripple effects throughout the world. For example, if Chinese factories slow down production, that would lead to fewer orders for raw materials from other countries. This would, in turn, lead to job losses in those countries, as well as lower incomes and higher levels of poverty. 3. A downturn in China could lead to financial market turmoil. This is because a lot of global investors have been betting on China's continued economic growth. If China's economy slows down sharply, it could cause a sell-off in global financial markets. 4. A slowdown in China could lead to lower commodity demand, like oil and copper. This is because China is a major consumer of these commodities, and a slowdown in their economy could lead to less demand for these products. This could lead to lower prices for these commodities and could impact the economies of countries that produce these commodities. Is there any light at the end of the tunnel for the Chinese economy? It's hard to say for sure, but there are a few reasons to be optimistic. For one thing, China's government has been taking steps to address these issues. They have been working to reduce the amount of debt in the economy and allow the yuan to weaken against other major currencies. This will make exports cheaper and help stimulate growth. One of the steps the Chinese government has taken to reform its economy is by authorizing the 2025 Made in China plan. Their current president, Xi Jinping, was the one who spearheaded this plan. The plan calls for technological advancements such as big data, aviation engines, and clean automobiles. Meanwhile, they have also been taking steps to support their stock market. This may seem counterintuitive, but many experts believe that this is a necessary step toward building investor confidence. So it looks like China's government is aware that a crash is coming and is trying to prevent it. There are some who believe that the current problems in China are just a blip on the radar and that the country will eventually bounce back. Others are not so optimistic and believe that a recession in China could trigger a domino effect that would lead to a worldwide economic downturn. No one knows for sure what will happen, but it's important to keep a close eye on the situation. If the Chinese economy does enter into a recession, it could have severe implications for us all. Economic consequences. The Chinese economy has been in a state of flux in recent months, and this has had far-reaching consequences for the global economy. One of the most significant impacts has been the sharp decline in demand for commodities, particularly metals and minerals. This has caused prices to plummet and has put immense pressure on commodity exporting countries such as Australia and Brazil. The Chinese economy is also a major market for luxury goods, and its slowdown has led to a sharp drop in demand for these items. This has been particularly damaging for European luxury brands, which have come to rely heavily on the Chinese market. The knock-on effects of the Chinese economic crash are still being felt around the world, and it is clear that the global economy is now more vulnerable than ever to any further slowdown in the Chinese economy. Final thoughts. As you know, the Chinese economy has been slowing down for years. And with a government that has been artificially propping up the economy, it's only a matter of time before a financial collapse occurs. It's already beginning to happen and will only worsen before it gets better. The Chinese economy accounts for over 18% of the global economy, so if it collapses, the world will be in for a bad time. It's not a matter of if this will happen, but when. Don't forget to hit the like button, subscribe, and leave a comment below. Thank you for watching.